Welcome back to the audio edition of Tuesday Target. I'm Constantine.
And I'm Penelope. Today we are breaking down the latest letter from Juri von Randow titled Zero Seats, Infinite Compute. And Constantine, the lead story this week is aggressive. Juri looks at the correction in software stocks and sees something much deeper than a standard dip.
He really does. He calls it a terminal diagnosis for the subscription economy. It all comes down to the business model.
Exactly. Think about the standard per-seat license. Companies pay a monthly rent for every human user who logs in. But Juri argues that AI agents change the fundamental unit of work. An agent executes the workflow without a human in the seat. It consumes raw compute power and completely bypasses the dashboard.
So the value shifts. It moves away from the software middleman and toward the infrastructure powering the agent. The market is violently repricing that shift right now. And capital is reacting by fleeing Silicon Valley to find a home in a very unexpected place.
European manufacturing, specifically Germany. Juri points out that while American tech chases a threatened business model, Germany is posting a pulse in loan growth and factory orders. Money is flowing there because the valuation gap is just too compelling. It is a structural rotation from rent seekers to makers.
Speaking of global money flows, there were some heavy headlines about Beijing dumping U.S. treasuries. Juri suggests we should look past the panic.
He views it as a domestic plumbing fix. The Chinese banking system needs liquidity ahead of the Lunar New Year. They are prioritizing internal stability. The headlines see geopolitics, yet the reality is purely operational.
Let's look at the liquidity picture closer to home. The Federal Reserve claims to be holding steady, but the balance sheet tells a different story.
They have quietly restarted expansion. They are adding $40 billion a month. Officials label this reserve management, yet the mechanical effect on asset prices mirrors quantitative easing. It lubricates the repo markets and suppresses volatility.
It acts like a silent put option for the market. It loosens financial conditions regardless of the official interest rate. But Penelope, we have to talk about Japan.
A massive shift there. Prime Minister Takaichi's landslide victory gives her a mandate for aggressive fiscal stimulus that virtually guarantees higher government spending and upward pressure on Japanese bond yields.
Which matters for everyone. A steeper yield curve in Tokyo challenges the global carry trade. The era of the yen serving as a dormant funding currency is ending. The world has to account for a waking Japanese giant.
That brings us to asset classes. Juri highlights a sharp divergence between Bitcoin and gold. They have completely decoupled. Crypto is trading in lockstep with high beta tech stocks. It acts primarily as a liquidity proxy.
While physical gold is rallying on sovereign debt concerns, institutional capital views bullion as the true hedge against systemic instability.
Looking at the week ahead, traders are walking into a binary data gauntlet. We have the two most critical macro prints, jobs and inflation, colliding within 48 hours.
It starts today with retail sales, but the real volatility sandwich is Wednesday's payrolls and Friday's CPI. Juri warns to expect algorithmic whiplash. Technical supports will likely yield to headline risk. The charts simply won't matter until the data settles.
So what are the tactics for this tape? The newsletter suggests the market structure is fragile. Single stock volatility is exploding. The strategy here is reducing gross exposure and using cheap options premiums to hedge downside risk.
And for those looking to rotate capital, the smart money is moving into real economy beneficiaries, regional banks and industrials that profit directly from a steeper yield curve.
Finally, let's look at the contrarian trade idea. Microsoft. Juri notes that the market has punished software so severely that Microsoft now trades at a lower forward PE multiple than IBM for the first time in a decade.
That is a wild stat. He acknowledges the threat to software is real, but a 30% drawdown implies the pendulum has swung into absurdity. The play here involves selling into the high volatility panic to acquire exposure to that balance sheet. You get that entry at valuations we haven't seen since the zero interest rate era.
It is a fascinating setup. As always, for the official trade alerts and the elite trader plan details, check the full newsletter. Thanks for listening to Tuesday Target.
See you next week.